Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Monday, everybody. In recent days, we learned that several major PRC cities are cutting second-half spending in anticipation of revenue declines resulting from zero-COVID policy demands, as well as hits to revenue from a mix of economic slowdown and tax cuts to stimulate rebound. We have been expecting something like this for some time now. Local governments have been grappling with a financing crisis for months now. Another crisis, the housing one, had already hit revenue with land use sales collapsing across many regions. We remember back in May, the State Council increased the total of tax rebates and cuts for businesses this year to 2.64 trillion RMB. As we will see, even with spending cuts in some areas, local governments are still seeing surging debt with more issuance of bonds for infrastructure spending. Indeed, according to data released last Tuesday by the Finance Ministry, central and local government revenue plunged 41.3% year-on-year in April. According to Chinese financial media outlet Yicai, the municipal government of southwest Chinese megacity Chongqing plans to cut 5 billion RMB, approximately $746 million of planned general public spending. According to the city's second half-year budget just published, Chongqing plans to reduce spending on general public services, public security, social security, employment, health, urban and rural communities, agriculture and transportation. The eastern city of Suzhou has taken another route, according to a budget adjustment plan released last Wednesday, choosing to, quote, reduce outlays on public receptions, conferences, trading, overseas business travel, and non-emergency projects. End quote. The plan expresses that the adjustments are sustainable in the short term and that, quote, as the economy recovers, revenue will rise. End quote. Well, they better hope that there will be a strong recovery then. The director of Suzhou's Finance Bureau, speaking to Chinese financial media, expressed that the city hopes for a rebound in the housing market as well, saying that the housing slump has, quote, significantly affected the city's land sales revenue. End quote. Another official in the same bureau expressed that if revenue in the final 6 months continues to decline as in April, the government will need to cut spending further. We can see here very plainly the systemic and reinforcing effect a prolonged housing downturn can have on the wider economy. The fiscal pressure on local governments will also likely contribute to the ongoing friction between local and central government. Quote, the primary long-term reason for the weak economy and declining government revenues is weak domestic demand caused by stagnant consumer growth. The irony is that the spending cutbacks by local governments are likely to weaken consumption further. This is something we should be watching closely because it illustrates what I expect to be 2 major problems in future years. The first problem is the pro-cyclical nature of China's economic adjustment. The second is the intense pressure on local governments to absorb a disproportionate share, relative to Beijing, of the costs of adjustment. I expect conflict with Beijing and local governments to intensify over the next 2 to 4 years. End quote. Now, speaking of this relationship with the central government, Beijing is betting hard on its old playbook of infrastructure projects and that this will save the economy once again and hopefully give it a few more years to transition to a more sustainable growth model. Economists remain divided regarding the wisdom of this approach. Last week, yet more infrastructure projects were announced, with a particular focus on increasing employment and facilitating consumption in the second half of this year, according to state media. The State Council announced that local governments will raise another 300 billion yuan, $44.8 billion, to finance infrastructure projects primarily by selling financial bonds to policy banks. That is in addition to the 800 billion RMB China's 3 policy banks were told to lend for infrastructure projects last month as well. Quote, the new stimulus can, in theory, leverage as much as 1.2 trillion yuan in credit from the banking sector and capital markets, but its impact in reality could be much smaller and won't be enough to plug an estimated 6 trillion yuan funding gap that the government has to fill if it wants to carry out its proactive fiscal policy. End quote. Hey guys, if you enjoyed the episode, don't forget to hit the like button, and if you appreciate what I'm trying to do here with China Update and you would like to help keep it sustainable, Patreon and Buy Me a Coffee links are in the description below. As always, thank you so much everybody for the ongoing support. Next up, officials are scrambling to snuff out new COVID cases as several new clusters of Omicron appeared in new urban centres over the weekend. Yet another reminder that entire cities can be plunged into restrictions and mass testing and even lockdown without warning. After a few days of cases in the low dozens, China reported 385 local cases on Saturday. A lockdown has been imposed in Ningbi County, population 1 million, in northeastern Anhui, eastern China. Surrounding counties are continuing daily mass testing. Wuxi, population 6.5 million, a manufacturing hub in the Yangtze Delta on the central coast, not too far from Shanghai, halted operations at many public venues, suspended dine-in services in restaurants, and advised people to work from home after reporting 42 new asymptomatic cases on Saturday. Dozens of cases were officially reported too on Sunday. Other cities in the mainland are dealing with sporadic cases too, with official infections detected in the provinces of Anhui, Jiangsu, Liaoning, Fujian, Shandong, Shanxi, Zhejiang, Guangdong, and Sichuan. The Macau Special Administrative Region continues to deal with a small outbreak too. Next up, and returning to the theme of the economy, in April and May of this year, China's economy, already facing a housing crisis and a tough international environment, cratered with the Shanghai lockdown. We may finally be seeing some stabilization in June, though even an eventual return to March levels wouldn't represent a recovery as the general economy still faces many challenges. But stabilization is certainly better than further collapse at the very least, though the risk of new outbreaks, which could plunge critical regions back into lockdowns, is real too. Caixin Media writes that activity in China's manufacturing sector rebounded into expansionary territory for the first time in 4 months in June, according to its Caixin China General Manufacturing Purchasing Managers Index, PMI, which it claims gives an independent snapshot of the country's manufacturing sector. The index rose to 51.7 in June, a number above 50 signals an expansion in activity. Below 50 means contraction. New export orders also grew in June for the first time since July 2021. Caixin Insight Group's senior economist Wang Zhe explains that the manufacturing rebound was driven by the loosening of COVID restrictions in Shanghai and other places. While this sounds like good news, some economists expected a bigger rebound in June. Now, let's move from manufacturing to the housing sector. After almost 12 months of monthly sales collapse, are we finally starting to see some stabilization of housing in June? If we are generous with how we define stabilization, then perhaps we may be. According to new data from property industry consultancy China Real Estate Information Corp, China's home sales picked up in June, a sign that the shell-shocked market may be bottoming out with the help of government support measures. The total sales of 100 top real estate developers rose by 61.2% month-on-month to 733 billion RMB, approximately $109 billion, a far better performance than May's 5.6% month-on-month increase. We remember that these month-on-month increases are from very low bases. Sales in June were still down by over 40% year-on-year, in what, as we can see, Caixin analysts have described as a horror year due to, quote, industry-wide debt and liquidity crisis triggered by the tough deleveraging campaign and spearheaded by regulators. End quote. China Real Estate Information Corp warns that significant headwinds remain for the market, however, stemming from what it calls 3 major unresolved problems, all on the demand side. The same demand side that Beijing is trying, so far unsuccessfully, to support. First, home buyers have lost confidence that developers might not be able to finish projects. Second, buyers are willing to see if home prices drop. And third, the lockdowns and economic pain from this year have hit many household incomes, reducing the number of families who can afford to buy homes. Quote, the housing market faces some major challenges today, particularly buyer confidence. Never have I seen such lackluster demand for real estate, not even during the 2008 financial crisis. The growth and the profit margin of the real estate industry have both peaked. I am afraid the real estate stocks will become a classic value trap going forward. End quote. Okay, that is today's episode, everybody. Thank you so much for watching. I'll see you tomorrow.